While everyone is freaking out about NVIDIA, the AI mania, and this massive bubble that's supposedly going to pop any minute now, not many people are left watching small caps. But the rally in the Russell on the Thursday and Friday session gives me hope that we will be alright, at least for now. So let's take a look at the data points and build a logical game plan to tackle the week ahead. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure, solid green-bodied bar with just a little bit of a lower wick. If you're going to read into that, it would just imply that the buyers stepped up near the lows of the range. They were able to push prices back up to the opening print, and of course through the opening print for range expansion into blue sky territories, and we have ourselves a close at a new all-time high. So definitely bullish in terms of structure. Location-wise on the bar-to-bar count, we have a higher low as well as a higher high, meaning that buyers go 2 for 2. It's totally bulls on parade here. The trend is certainly in the upward direction, and we're sitting at the highest high in the trend count. So as we know, if there is some sort of pullback that starts to develop, we can look for a higher low, and it will not change the weekly trend. The buyers remain totally in the driver's seat here. There's no indications that a pullback is imminent up here, but the level that we're going to start paying attention to, or that we'll continue to pay attention to, I should say, is the top of the balance range at 477. And if we take a look at the previous all-time high, it's also confluence with that. So this is closer to 480, the previous all-time high. This is closer to 477. Let's not split hairs on a now $500 product. 3 points of zone for wiggle room on the higher low pullback, certainly well within reason. Let's go ahead and take out a Fibonacci from the October low and bring it on up to the top of the most recent move. And as we take a closer look, the bottom of the balance range we just described is the 38.2. So if the market is most importantly going to respect the structure and do something that looks like this, turning prior resistance into newfound support, that would be cleaner. And it's also well above the 38.2. So from a depth perspective on the pullback, not an issue when it comes to retracements. Let's go ahead and take a look now through the lens of anchored VWAPs on the weekly. And as we described in last week's episode, this is really having more to do with the monthly higher low thesis. I don't foresee these playing any important role in the coming week's worth of trade. Finally, for our studies, we'll bring out the volume profile. And what you'll see here is a high volume node smack on the lows of that balance range here. So if the market does see a pullback and finds support above structure, it would also make sense that we're being drawn towards a high volume node supporting above it. Makes sense. Buyers would remain in control. No issues from that point of view. As we're moving into new all-time highs, the key question remains, what are the targets overhead? And as we know, the cup and handle that looks something like this has broken out, and we're certainly well on our way towards the measured move target. So let's bring out the Fibonacci extensions from the base of the cup to the top of the cup to the low of the pullback handle. The first takeaway here, before we even look at the 100% extension, is that the 61.8 is additional confluence at 477, 480, furthering the idea that this is another reasonable data point to include in the narrative. Great, right off of that 480. That's based on the extension, has nothing to do with the retracement of the rally that we've seen so far, right? So interesting how that works out. Let's go ahead and take a look at the 100% extension now, and that's up here at 520. Now, when the cup and handle originally broke out, and we were way back in this segment, like early on, actually, that was still in 2023, right? When we were breaking out, we were like, 520 might be a pie in the sky target. It's really not what we're thinking about this month, next month, or even the month after that. But take a look at what's happened recently. I mean, we've basically moved 20 points here in the SPY over the course of 3 weeks. And if we see another consecutive 3 weeks for 20 points, we're going to be at 520. And the idea, again, is not to say that that needs to happen. We don't need to get there in 3 weeks, but 520 is a respectable target now. It's not just a pie in the sky number that's suggestive of, okay, the pattern can resolve in the upward direction. It's a real target that's going to have some bearing on what happens as we approach that level, right? So 520, it should be on your chart, or it should be in your head as a valid target to the upside. The next thing we'll talk about on the weekly is just understanding the context about the bubble that everybody's talking about here in terms of AI, semiconductors, and more specifically NVIDIA. And to provide some more context, let's rewind the clock and take a look at what happened in the dot-com era. You'll see over here that this pullback might be similar to the pullback that we have over here. This, in terms of magnitude, was about 50% when the bubble ultimately popped. The bubble popping, so to speak, big air quotes on that. From the sickness here, in terms of duration, it was similar, but in terms of magnitude, about half as much. It was about a 25% drawdown. So let's think about this low to this, just to get our bearing on our comparisons, right? So let's take a closer look over here. And what we want to measure is the additional gain after exceeding the previous high. So this move right here. We'll bring out a measuring stick and we'll come in from that high up to the top of the dot-com era. And what you'll notice is that rally was loosely 31%. And before we take a look at the more recent price data, I also want to point out that as the market's making its move to the downside, you flip into a downtrend on the weekly well in advance of these large drawdowns, which everybody remembers as the painful moments of the dot-com bubble bursting, right? In here, you have highs, lows, lower highs. You're in a weekly downtrend before the three large painful moments in the dot-com bubble burst, right? The same thing holds true in the great financial crisis. You get a double top, then you get a lower high. Equal lows are already on the table. Lower low, you're already in a weekly downtrend here before the big hallmark moment that everybody remembers as painful in 2008, right? So now let's go to the recent price data, and I'll let you make your own conclusion here, but we'll zoom in and remember the number was 31%, all right? So what we want to do is take the measuring stick from the previous high to where we are trading currently, and what you'll notice is it's hardly 10%, 9.63%. So knowing that, I'll let you decide. Are we at the beginning, middle, or end of the bubble? On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 507.73, implying a higher high in the trend count as well as a new all-time high. And if we're contained by the lower bound, the number's at 494.69, implying a higher low. It's also confluence with the gap close from the Monday and Tuesday highs of last week. So expected move does strike me as more bullish than bearish. The daily trend is certainly up with lows, soft higher lows. We know that we have highs, higher highs, and of course new all-time highs on the Friday session. So because of the current location in the trend sequence, we know that we can afford a higher low pullback. But just like the weekly chart, there is no immediate indication that a pullback would be imminent here. The three locations I would really pay very close attention to would be the highs of the Wednesday and Thursday breakout. So they're two equal highs at 498.25. Consolidation inside of Friday's range or just above that level sets up beautiful consolidation for continuation. If we break down underneath that area, I would be thinking about the gap fill reversal and the lower edge of this week's expected move. Technically, the gap closes underneath 496 down towards 494.30. Again, the lower edge of the weekly expected move is a suggestion by the options market saying, hey, wouldn't be unreasonable if we get down there and then start to find some slowing down of downside momentum. If there is a breach of the expected move, though, the third location on the daily time frame chart where we will remain in an overall uptrend is a pullback to attempt one more time, 491.50. Remember that these are soft higher lows because we never actually flipped into the hourly downtrend. Of course, to get there from the all-time high, we would definitely be in an hourly downtrend, right? So 491.50 if attempted one more time, because we're coming from the highest high in the trend sequence. It's not an equal high. It's not a lower high. I'm still willing to give the buyers the benefit of the doubt and looking for a daily higher low to be cemented at 491.50. But let's ask ourselves the key question, and this continues to be the key question to ask as we navigate in the upward direction. Are there any indications of stronger sellers here? And the answer is just simply no. Friday's close at the high of day, no larger upper wick, a breakout of the two-day highs from the Thursday inside bar. Thursday, we saw the rotation into small caps, keeping the S&P more sideways. There was no gap close underneath here. We looked underneath the prior structure on Monday, but closed back above, used it as support on the Tuesday session. No indications of stronger sellers by any stretch of the imagination. And what we know is taking place is just the rotation among two different groups, right? It could be out of tech and into small caps, or it could quite literally be inside of the core list of companies itself. They could sell NVIDIA, but buy up Meta. They could sell Amazon, but buy up Apple, which has been a laggard last week. And as long as there's some sort of rotation in the core list of companies, the market will not take a tumble. The one thing you might want to be mindful of here, though, is the correlation risk. Notice that on Friday, small caps were up 1.23%. NVIDIA, the one stock to rule them all, up 2.27%. Almost everything was up here except for your Meta, and your Netflix. Apple was a laggard, but everything outside of that was up more than 1%. So if there is correlation risk to the upside, it wouldn't be unreasonable where if the IWM takes a breather after 2 aggressive days to the upside, if NVIDIA takes a breather, if Amazon, if Google, if Microsoft, if all of these names take a breather on Monday because they were green into the Friday close, yeah, you could look for a sideways S&P or maybe that deeper pullback, deeper in big air quotes there, to close the gap at the lower edge of the weekly expected move. But as soon as that rotation continues or restarts, I wouldn't be looking for anything further to the downside. Where the tone really changes in the S&P is when everything is down like 2% or worse, and it continues that way for a number of consecutive days. But if you're getting a mixed bag after one down day, I think the rotation is alive and well. Let's get more granular and take a look at the hourly. So we can certainly see here that we're also in an hourly uptrend with consecutive higher lows as well as highs, higher highs, or even if you wanted to start here, highs, higher highs, and higher highs. Certainly an opportunity for hourly higher lows over the top of the breakout point that we were just discussing at 498.25. One interesting nuance for the gap close to the downside is that if we slip underneath this level right here at 497.10, this all turns into overhead supply, and I could see a short scalp unfolding where this is the idea, right? A lower high underneath 497.10 aims to close the gap, and when and if we get down here, we're looking out for buyers to step in. Can we see the gap fill reversal, then move back in the upward direction? If we take out the Fibonacci's on the hourly here from the low up to the most recent high, what you'll see is the 38.2 is confluence at that gap fill reversal. Again, that level is 494.30. If we bring out the anchored view apps from an intraday perspective, you are getting some confluence off of this fan of anchored view apps. We would be above the bottom, which is technically this one down here. And the place where larger concerns really come in on the S&Ps are if we do see this breakdown, and let's say that we consolidate in the gap, we test that 491.50. If we're underneath 491.50, that's where this, in my opinion, really becomes more concerning. And we know that on the Monday session, there was really horrendous breadth. It was NVIDIA saving the day here. As we were going sideways and with this breakout on Wednesday, there was really no follow through in the internals. As a matter of fact, we can just jump over there now. If you're not familiar with this screen, check out the video tutorial in the upper corner. But here's Monday, right? So if we're underneath that session, if we start breaking down underneath that 491, this is where I would say the breadth concerns are really illuminated, right? And what we're looking for is red across the board, as we were talking about on the SPY Daily, across not only the core list of companies, but no rotation into small caps either. You can see that the breadth was horrendous as the market continued to grind in the upward direction for the last 3 days of the week. The advanced decline line, although mostly positive, was tangled near the zero line. It certainly was not spending time in trend higher zone, and the cumulative tick was really not impressive until the Friday afternoon session. There's really no moment in here on Wednesday and Thursday specifically where I would say, oh yeah, there's a clear bullish edge to the market. It really took all of Friday afternoon to build this thing up to a net read of roughly 4,000. And what do we know is the classic substantial read? It's 5,000, either positive or negative if you're looking for a downside move. And we were shy of that, even with the strength of the rally, the grind, if you will, all day on that Friday session. So overall, I think that there, again, is no reason to be overly bearish right here, right now. But if we do start to slip underneath some of this key structure that we've just outlined, primarily this level, right, which is the Monday low, where we just saw from a breadth perspective, that's where we saw substantial volume outflows on Monday. Monday was an advanced decline line to the downside big time. Not as much of a concern in the cumulative tick, but again, back to the hourly chart, if we slip, underneath the Monday low here at 491.50, larger concerns. If there's no rotation, larger concerns. All of this is very speculative, and the reason we bring it up is so we have a base case to manage against. As long as we're above this, as long as we're sort of thinking about the base case as this, as long as we're thinking about it as this, as long as we're possibly thinking about something like this perhaps, right? Head and shoulders inverted off of the 491.50, we know that stronger sellers, not really a threat. If that goes out the window, if we're underneath that 491.50, that's where the breadth concerns in the market internals start to suggest, okay, something is going awry here. Maybe the bubble believers start to come into play and say, haha, I told you so. But for me, I'll be a little bit more patient. I'll wait, quite frankly, until there's a clear breakdown and violation of this as a line in the sand at 491.50. Let's finish up the S&P 500 on the market profile through the lens of the ES. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. It's a very straightforward market profile, and as you can probably get the gist from today's video, it's not so much about the technicals, it's more about the market rotation, if you will. So you can see a rinse and repeat. Here's Monday's expansion of range to the upside. Here is Tuesday inside. Here is Wednesday's expansion of range to the upside. Here is Thursday inside, and on Friday, we validate the breakout with the value area moving higher, along with the point of control. We've got a decent excess low, a decent excess high, so no need for repair on those. This would be the equivalent of the 497.10 breakdown to close the gap in the S&P cash market, right? And then underneath this value area low is the Tuesday low, which is a poor low, by the way. And this level, if you've been tuning into the pre-market preps, you should know this like the back of your hand. At 49.55, that's your loose equivalent of 491.50 in the SPY cash. So the levels are very straightforward on the technical side of things. It's not like we have to be very forensic with them. But again, the focus, the emphasis of today's video is all about the rotation. So let's take a look at the NASDAQ. So here's the QQQs on a weekly time frame chart. What do we see in terms of candle structure and location? Extremely similar to the S&P. Solid green-bodied bar, maybe a little bit of a lower wick, still implying buyers stepped up and they were able to close at the highs of the weekly range, new all-time high. Of course, bar to bar is a higher low as well as a higher high. Buyers totally in control. We know we are in a weekly uptrend off of the October lows, and if we are going to get a deeper pullback, which again, there is no indication of based on candle structure and location, we're really looking for the top of the weekly range from back here, which is closer to 410, 412. If we zoom out on this chart, it's not as clean as Confluence with the previous all-time high. This is a little bit lower here on the NASDAQ side of things. Not the end of the world, because as we know, this structure would be better. If we could hold the higher level, if we could turn prior resistance in the local sense into newfound support, that would make a beautiful zone. Once again, 410 to roughly 412. Let's bring out the Fibonacci retracements from the lows of October to the most recent high. The 38.2 is kind of in no man's land through the bottom-ish end of this balance range, and it would still make more sense that a structural pullback that looks something like this would be respectful of turning resistance into newfound support, as we just mentioned. That would all be happening over a 38.2, which of course is more bullish than bearish. Let's take a look through the lens of the anchored view apps on the QQQ weekly, and just like the S&Ps, this is more so about monthly higher low zones. This one will start to play catch up. This might be something to pay attention to, the October low anchored view app, if a deeper pullback unfolds. But again, it's going to take multiple weeks before it's confluence with the top of the balance range from back here. Let's go ahead and talk about the measured move from the cup and handle after we take a look at the volume profile, or let's at least just put it on there, clean up the chart a little bit. So the volume profile is, totally suggestive of previous all-time highs as the volume shelf. Other than that, a deeper move towards like 360s, monthly higher low would be in store well before we start thinking about that as a major contender. So I'm not seeing anything alarming based on volume profile. Sort of just aligns with the idea that this level is top of mind if a deeper weekly pullback does develop, which as of right now does not seem to be top of mind. So back to the cup and handle and the idea from here. Let's see where we're at from that point of view on the NASDAQ, coming in from the low up to the high down to the base of the handle here. The 61.8 is not confluence with the top of the weekly consolidation. The 50% extension is, and then our 100% target is ultimately up here at 475. So much more of a stretch, if you will, out of the NASDAQ, but that's because the rally off of the lows was much sharper over here in the NASDAQ. Recall that if you were to compare the S&P to the NASDAQ, let's just zoom out here a little bit, this leg, if we take out a retracement from the sickness low, there we go, up to the all-time high, this went much deeper. It went all the way to the 61.8, whereas the S&P 500 sort of bottomed out around the 38.2. So the magnitude of this move off of the lows to the recent highs for the cup and handle, much more extreme over here in the NASDAQ. And once again, your target, your measured move, closer to 475. What we should take a look at is the equivalent of the sort of bubble era, if you will, in the early 2000s. So there's a couple of measurements we want to take for comparison. Let's take a closer look back here. The first one we'll take is we'll measure after breaking this high where this sharp pullback started to come in from. So if we take the break of the high and go up to where this pullback came from, it's roughly a 50% move, right? If I lock this in, you can see it's this number right here, 49.2% move in the upward direction. All right, so remember that, 50%. And then we'll take the final leg from the pullback low to the major high over here. We'll take this up to here, and you'll notice that that too is, it's not 50%, but let's call it 45% just for the sake of memory, right? So 50% and 45%. All right, now let's go on over to the recent price action and see where we stand in terms of those two levels, right? We'll come in from the low. How far has the rally gone so far? about 27.31%. I don't know about you, but that's certainly not 50%. It's certainly not 45%. So I'll pose the question one more time and I'll let you answer it. Are we at the beginning? Are we at the middle? Or are we at the end of the AI mania bubble? QQQ daily time frame chart. Now, what do we see in terms of the expected move? The upper bound is at 444.94, implying a higher high, new all-time high, and the lower bound is at 429.20, implying a higher low from here to here. Remember, in terms of trend, we had something really important take place on the Wednesday session where we finally broke out up and through all of these equal highs. The Qs were lagging the S&P without the new high being brought in on the Friday of 2 weeks ago, but you can see we've caught right back up. So new all-time high on the Friday session, two equal highs just like the S&P on Wednesday and Thursday. The trend, of course, is in the upward direction, so any consolidation above 432.65, bullish, looking for continuation. Deeper pullbacks for a retest of, I would call this an inverted head and shoulders pie in the sky, but certainly a retest of those equal highs at the lower edge of this week's expected move. Let's call it 429.25. Good to go, looking for a daily higher low there. I'd be a little bit concerned if we start to slip a toe underneath. It's not the end of the world, but the threat on a move like that is that this starts to feel like a failed breakout, and any lower highs underneath, now all of a sudden this maybe turns into a regular head and shoulders, and then a larger breakdown through the neckline certainly becomes a concern from the weekly perspective. But again, very speculative, very, very speculative. As of right now, there are no indications of stronger sellers getting involved as we made that push to new highs on the Friday session. In terms of the rotation, you'll of course have to pay attention to the core list of companies. We'll break those down as we move through them in just a moment here. Let's take a look at the hourly time frame chart. You can see clear as day how this pullback makes sense, finding a higher low there. This pullback makes sense, finding a higher low on the retest of the breakout point. You could use 430 as well, which was the high of the Friday session, the high of the Tuesday session as well from this previous week's worth of trade. If we bring out the Fibonacci's, any confluence on the NASDAQ, just like we had in the S&P, beautiful, 38.2, right off the level, right off the lower edge of this week's expected move. 429.25 would be my line in the sand, somewhere around this zone for the retest. As long as we're above it, looking pretty darn good here on the daily time frame chart as well as the hourly. Let's go ahead and throw on the anchored view app, see what else we can learn about the price action from this point of view. Very methodical. Look at how evenly these are spaced. Nothing more than just visual pleasantry. But if we do get this pullback, maybe confluence loosely with that anchored view app. This one will catch up over time if it's later in the week. Just the idea would be larger concerns emerge when and if we slip underneath the neckline, and by doing so, we start to break down underneath the anchored view apps and we are starting to use them as resistance. That, of course, is no longer a bullish sequence. So I would say again that these charts are very straightforward. There's no reason to get overly forensic with the price action as we're breaking to new all-time highs. Let's take a look at the market breadth out of the NASDAQ. You're seeing big inflows on that Friday session. The advanced decline line is not as tangled up on Thursday and Friday. And the same thing out of the cumulative build here on Friday, really starting to accelerate instead of be flat like we saw on the Tuesday and Wednesday session. So we'll give credit where credit is due. The sellers had something going on the Monday session, but thanks to NVIDIA, we sort of got a get out of jail free card applied to the market there. So again, the issue is only when we break down underneath this level. If we break down underneath that level, yeah, the Monday and Tuesday sessions start to become jeopardized. If we turn them into overhead supply, the breakdown underneath 426.25, the door is open because those moves happened on the week internals, right? This is the takeaway here, which is why the rotation is so critical at this market juncture. There's no reason to believe that stronger sellers are getting involved. It's just not happening. So let's move along and take a look at the market profile for the NASDAQ side of things, and it's basically a mirror image of what we just saw in the S&P, where your value area here. Don't get me wrong, Tuesday there were some concerns on Tuesday when NVIDIA took a backseat, even though Tesla did outperform. Look at the A-period single prints, and we already talked about on Wednesday how dipping a toe into them, not making the full rotation down here is technically a bullish indication. Stronger sellers would have had no issue working their way into that Tuesday value area and point of control. Obviously, the rest is history with the two-day high breakout and the value area and point of control on Friday. Migrate higher with price, decent excess at the lows and highs. No issues from that point of view. And if we were to fail underneath the three-day high range here, This is the first shot across the bow at 17,775, right? All the sevens as we talk about in the pre-market prep. 17,775 breaks down, and then the door is open, wide open, underneath 17,550. 17,550, if we go back on over to the price action, is the low of your Monday and Tuesday session here at 426.25. So I would not want to see price below the equal high breakout point here. We've talked about that in detail, 429.25. This lower high is dangerous, but the most dangerous thing is once we flip into that hourly downtrend and reject that on a retest, this is where the door is like, okay, let's buckle up, because we know that there's not a lot of, first of all, back over to the breadth, right? Not a lot of breadth supporting that move. And also in the market profile, it's where we start to see a slip underneath the poor low here. And this has the opportunity to turn into overhead supply. So one step at a time. Again, keep the technicals very simple. No reason to panic if we're above 17,775. Even better if we're above the 2-day high from here, getting consolidation up there, validating Friday's breakout. Some concerns start to step in if the rotation is not taking place and we start to break down underneath 17,550. And last but certainly not least for our broad market indexes, we have IWM, Russell 2000, and the small caps on a weekly time frame chart. I'm honestly thrilled to bring you this segment in today's video. What do we see in terms of candle structure and location? Right back in line with what's taking place in the S&Ps and the NASDAQ. The range here is actually more impressive on a relative basis in small caps. And what you'll notice is that we actually have on the bar-to-bar count a lower low, yet equal highs. So the sellers achieved a breakdown of the previous week's low, and there was absolutely no follow-through in the downward direction. As a matter of fact, the rest was history. The buyers responded in huge fashion and closed at that equal high, almost a bullish engulfer, but not quite. So when we talk about the small cap rotation being key at this particular juncture, it really is. If the momentum to the downside was going to yield a test of the previous hammer low back here, all of a sudden this starts to feel like a weekly double top, and now we can kiss this thing goodbye underneath the neckline, headed back down towards the midpoint of the overall balance range here. But now that this is continuing to play out as a bull flag, now that we're back up towards these equal highs, is it possible that after a big time weekly high or low, after a wall-to-wall move, right, directly from the bottom of the range to the top of the range, could we get a breakout here, and could that help support the efforts of the broad market continuing in the upward direction, specifically in the S&P 500? The answer in my eyes is absolutely, right? If this is going to break out of the monthly range, a range double brings us, based on a quick eyeball test, maybe closer to 235, 237s. That will act as a huge tailwind for the S&P 500, even if the tech sector and the chip bubble, so to speak, is going to pop and go to hell in a handbasket. So thrilled with the IWM weekly time frame chart here. If we take a look from a Fibonacci point of view, lows up to the highs, this has all been taking place over the 38.2, so no larger concerns. Again, if the momentum to the downside took out the neckline, which was looking likely in the early stages of last week, it was really that Thursday and Friday session which changed the tone. If we took that out, slipping the 38.2, no good. Right back down to the midpoint of the range, who knows? It's neutral to potentially a failed move at the highs of the balance range here on the weekly or even monthly time frame if you were to zoom out one additional level. Let's take a look and see what else is going on. Let's grab a little bit more time because we're very interested. Let's go a 5-year chart. We don't want to compare this to the dot-com bubble burst, of course, but what we do want to take a look at is this 38.2. Remember that this is almost equally as important. If we can spend more time here to step in the right direction, of course, we would want to see a stronger break up and over 212 for the full follow-through up into the 100% retracement back here, but one step at a time. If we're trying to be constructive on the broad market, really thrilled with the Russell weekly time frame chart. The buyers really put on a display of strength on that Friday and Thursday session. Let's grab the anchored VWAP on the weekly time frame, and again, all of this is happening above the cluster of anchored VWAPs. So you can probably hear it in my voice, I'm thrilled with what the small caps did into the end of last week. I really didn't think it was going to play out that way, and it certainly did. Let's move on down to the daily time frame chart, since we don't have to take the same comparisons there, and take a look. Right, if the weekly higher low is going to stick, we need a new daily uptrend. We were really banking on this inverted head and shoulders here, falling out of the right shoulder. This is where the struggle was early on in the week. It was underneath that right shoulder. Here's Thursday and Friday. I mean, boom, right back to the highs of that right shoulder. So now perhaps the inverted head and shoulders is this, or more appropriately in my eyes, I would start thinking about this as a higher low double bottom on the daily time frame chart. If we can break this as a neckline, 199, looking for the equal high, we talked about that on the weekly, closer to 205. Speaking of, that's the upper edge of this week's expected move at 204.42. The lower bound of the expected move is beautiful confluence right now with the daily 50 SMA at 194.25 roughly. So as long as we're inside of the expected move, we have ourselves a daily higher low. And maybe this turns into the next inverted head and shoulders, right? This is the left, this is the head, this is the right. That's a possibility, but again, if we're just trying to keep it simple, I would try to align with or participate in the reversal off of this as a double bottom. Again, your neckline in that pattern is over 199. The Friday session also did something incredibly important, and to really see this, let's move on down to the hourly time frame chart and take a closer look. What do we know about 196.50? This was the level that was probably the most stubborn I've seen in a very long time, right? Resistance off of it, we gapped up above, no higher low above. We've gone through this so many times. We've said no higher low above. On the FOMC day, it was looking a little bit promising, and Jerome Powell wiped it all away with his magical sequence of words. So ever since then, it's been a struggle at this 196.50. What happened on the Friday session, you can see in that first opening range, the first 2 hours of the day, we found buyers above 196.50. So a huge move, like that's a big, big win for the buyers who are trying to remain constructive on the broad market moving in the upward direction. So going forward here, a couple of things, right? We talked about on the daily how if this is going to be your inverted head and shoulders, you could find that right shoulder over 194.25, but I would prefer to see it up and over 196.50 for all of the reasons we've just discussed here on the hourly time frame. Let's quickly throw on a Fibonacci from the low up to the top of this move, and yeah, look at that. I mean, the 38.2, it's not beautiful, could be better, but it's right within striking distance. It really is. So any consolidation up here looks good. You can probably hear it in my voice. Again, really thrilled about this rotation in small caps. And to be honest with you, I've got no position in small caps. I do have positions in the S&P, and that's probably where the enthusiasm is coming from when we're thinking about the broadening nature of the market itself. Let's continue and take a look at the anchored view apps here, and we can see what we can see. And hopefully this is still objective in the same vein. Although we have S&P positions, right, this is still objective here in noting all of the structural elements we've talked about. This is like this cluster of anchored view apps directly on the lows of that potential right shoulder on the deepest of pullbacks that would respect this previous level. Makes sense to me. This one in here moving higher over time, 196.50. Again, I think that we want to be constructive, looking for higher lows if there's going to be an equal high pullback or just straight up continuation over the 199 is very bullish for small cap. So we've made our case here. Let's continue to build the case over in the internals for the Russell side of things. And what do we see? Certainly strong volume inflows on that Friday breakout, substantial on the individual session. The net flows on the week are also substantial here. I always use 125 million in the Russell because it's a lighter index. We're not usually looking for 500 million or 600 million like we are in the NASDAQ or S&Ps. In terms of the advanced decline line, more time over the zero line on the Thursday and Friday session. And ticks, look at the ticks, huge builds on that Thursday and Friday, especially in relationship to the bearish nature of what we had on Monday, Tuesday, and Wednesday. So overall, again, just very, very pleased with the small caps here, continuing that rotation. You can see it in the market profile as well, where the value area is here, midpoint of the range, higher in the range, overlapping to up, certainly breakaway to the upside, certainly breakaway to the upside as well on the Friday session, validating that move higher. You can see that we have poor highs, incredibly poor highs, right? On the Wednesday, Thursday, and Friday session, him right across the top there in the three TPOs. So those could all, this one has been repaired. You can see based on the interaction on the Friday low, this has also been repaired. But if this needs to be traded through, I mean, that's just asking for continuation in the upward direction. You test that, you're expecting a break because the auction ended improperly based on the momentum that's starting to come into the small caps. Again, you can hear it in my voice, really looking for that continuation. Or if we do pull back, there's nothing saying that this level right here couldn't offer a potential higher low. You're coming back down into the previous poor high. The point of control is there. The value area is there. So if these buyers want to defend from the Thursday session, that would be a great place for them to step up loosely around that 1990 area. We've talked about music nonstop in the pre-market preps. It's a good time. If you're not joining us in the pre-market prep, it's live every morning on YouTube, 8:15 Eastern time on Monday. We will start at 8 o'clock and cut off at 8:45. We've got some business to take care of, but then we're back into the normal schedule on Tuesday. With that said, let's move along now into our S&P sectors. Let's get granular and take a look at the weekly performance of our sectors here. We can clearly see that leading the pack is not an S&P sector, but the SMH is the semiconductor ETF, up a whopping 5.33%. Certainly a risk-on indication supporting the move that we're seeing in the S&P and the NASDAQ. Directly underneath is the XLY for consumer discretionary. You can say thank you to Amazon and Tesla for that one. XLK is going to be your Apple and Microsoft, up 2.35%. And by the way, XLY was 2.51%. Then underneath, it's the XLB, up 2.26%. I mean, XLB is a lighter weight sector. It's not risk on or risk off in nature. It's just lightweight, so not the end of the world to see that. At the bottom of the barrel, it's the XLP. XLP is consumer staples. That is a risk off sector. It's also a lighter weight sector. So as the market's breaking to new all-time highs, the sector rotation is also making sense and aligning with the rotations we're seeing inside of the core list of companies and between small caps and the tech sector up here. Underneath that is the XLU, utilities, also a lightweight and D for defensive sector, down about 1.02%. So this is all making sense. The XLC, not the best display of strength here, down 0.15%. XLC, it's not the heaviest weighted sector, but it is definitely more risk on in nature. Let's take a look at these structural charts and evaluate what's happening. SMH, I mean, just literally shake my head. There's nothing bearish to say about this chart. Any high or low pullbacks over 196 continue to rock and roll, straight up continuation. Again, there is no indication of a pullback being imminent based on Friday's structural bar, the location up here. Even if you were to get a weekly high or low pullback at this point, you could look underneath these highs. Wouldn't prefer it, of course, but you could look underneath, find a higher low at 190-120, and move back in the upward direction. When and if this starts to take a stronger tumble and this starts to look like overhead supply, meaning we're underneath 187.35, we'll certainly start telling you like, hey, red flag, warning, why is the SMH underperforming so much? But if it's being rotation into the IWM, or if there is a rotation into the IWM as that's taking place, who knows? Maybe the S&P does not get hit as badly. Certainly, the NASDAQ would not be able to, NASDAQ would not benefit from the IWM rotation, right? Let's continue along, though, and take a look at the XLY, finally getting that price acceptance up and over 177.80, looking good here for the continuation move to 182. That is risk on in nature, not seeing any concerns here. Higher lows over 176.50, the top of the range here. Good to go. Buyers in control. XLK, it's the same concept. Higher high, pullbacks over 205.85, rock and roll. Even the retest of this, right? On the hourly chart, this would look like a pie in the sky inverted head and shoulders. Retesting that neckline at 203.60. Good to go. Nothing bearish to say. If we start to slip underneath $200.65, larger concerns start to emerge, but we're just not there yet. Let's take a look at the XLB. It's up there in terms of performance, but it's still stuck sideways in this range here, considering it's an extremely lightweight sector, the lightest weight sector in the S&P. No comment. I mean, upward pressure is upward pressure, downward pressure is downward pressure. It's not going to move the needle. Next up, we have industrials, 3-day range up here at the all-time highs. Either breakout over the top is bullish or a weekly high or low over the previous all-time high at 114.25. Good to go. When we're talking about pullbacks to retest previous highs, keep in mind that this, of course, means a reasonable daily pullback in the S&P 500, right? Next up, real estate. Any concerns here? Nope. Absolutely not. Trying to find buyers on the retest of the top of the previous range. No issues. XLV, the healthcare sector, second heaviest weighted sector by market cap, but D for defensive, new all-time highs, but pulling back mildly off of those all-time highs. If there was going to be a risk-off or defensive sector outperforming, we want it to be the healthcare sector, right? Because of the sector weighting. So all good there. Would love to see a daily high or low, 141.30, good to go. It takes a little bit of a breather. It allows the small caps to potentially keep the S&P sideways. That to me, beautiful. So watching XLV, any higher lows, and again, there is no suggestion. Notice that sure, we have a shooting star on the Wednesday session, but then back-to-back hammer-esque style bars, buyers stepping right back up at the previous all-time high. There is no suggestion of the deeper pullback, but this is okay. No issues here over 141.30. Next up, what do we see out of financials? Leaves a little bit to be desired, building out a compression of range here, looking for the breakout to the upside if we're going to remain totally risk on in this marketplace. Keep in mind that IWM has some smaller biotech companies, has some smaller banks, some smaller energy companies. So really watching the XLF, if it can break out of this range here, that in my eyes would support more of a tailwind for the IWM, just as sort of a a parallel, not one-to-one, but parallel, if you will. So watching this range compression, the 3-day balance into the end of the week looks good to me. It was over the 2-day highs of the Monday and Tuesday session here, lower wicks on the Wednesday and Thursday, seeing if we can just get that follow through. If we do, there's some room to run 40-40. That's looking pretty good for a risk on move in the S&P 500. Next up, energy, really sideways, a little bit concerned with the possible right shoulder here on the inverted head and shoulders that looks something like this. Large bearish engulfing bar on the Friday session. If we were to sweep underneath 82.75, not really the greatest look. Remember that energy is not a risk-off sector, but it's a lightweight sector, which is why we don't want it leading the pack when the S&P is making a new all-time high. So not thrilled with this. Global demand for oil, global economic concerns maybe start to come back into the forefront if we're underneath this 81.20. So keeping an eye on this one into this upcoming week, but certainly not a make or break yet for the marketplace. Here's the XLP. After making a higher high, pulling back mildly to retest this, I mean, what else do you want, right? Beautiful move here, constructive in terms of this trend here. It's not outperforming to a substantial degree. We know it's not making new all-time highs. It's not even taking out these pivot highs. So because it's a risk-off sector, to me, this is fantastic. It's certainly adding upward pressure to the marketplace, but not to a degree where we have to question, all right, why is there outperformance in a defensive sector, right? Next up, let's take a look at utilities. Getting completely beat up here. H pattern, lower high, lower lows, no issues, right? This is D for defensive. It is lightweight in terms of its impact on the S&P. So not as concerned. If this is what the XLK chart looked like, yeah, run for the hills. But utilities, no issues out of that one. XLC, communications, again, it's red on the week, but has it done anything bearish here? Absolutely not. Big gap up based on the meta earnings, of course, and now we're just sideways digesting those gains, all inside bars from that gap up session. So even if we were to close the gap underneath daily higher lows in store, break out from this consolidation, of course, that's bullish pressure for the S&P. Sector-wise, and even small cap-wise and rotation-wise inside the core list of companies, I'm not like everybody who's telling you to bet against this bubble is not taking in the higher time frame context. If the market does break down and we drift into daily, weekly downtrends in all of these charts that we've just blown through, great, we'll change our tone. But as of right now, I don't know about you, I'm a higher low pullback buyer, not an all-time high shorter. Let's take a look at the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This looks good to me. This looks like it could potentially turn into a red flag. This is trying to continue in the upward direction. We have equal highs after a higher low. Really want to see it back up towards that 50 SMA. This does not look like an issue to me, rolling over underneath the 50 SMA. Remember that XLV is defensive in nature. This is not an issue. This is not an issue down here. Same thing with energy because it's lightweight nature and real estate as a hard asset being defensive. XLC, lots of distance between it and an upward sloping or maybe even flat 50 SMA at this point in time. The largest thing to watch for is will financials break out of the compressed range we saw on the structural chart? And if so, that would act as a tailwind, right? It would continue to sort of offer a risk on sentiment if this could break the structural range in the chart and recapture the still upward sloping 50 SMA on the ratio grid. So far so good. Risk on remains the primary sentiment, or at least risk off is not the primary look here. And that could also be reflected in the XLK over the SHY, making a new high here. Same thing on the XLK over the XLU, new high here. Then we can throw in our apples to apples comparison on the XLY, XLP. We talked about this on Wednesday. What did we want to see? We wanted to see a recapture of the 50 SMA to sort of stop the look of a lower high here and become more confident in the look of a weekly or even monthly higher low here above the top of the range. This, as a small inverted head and shoulders, is beautiful, up over that 50 SMA, looking for now continuation into that equal high, and that would strike me as a bullish look for the broad market as a whole. New ratio that we've added to the lineup is the SMH over the XLV. Because semis are so important, how do they stack up against healthcare, which healthcare is D for defensive, but remember that the structural chart is actually performing quite well. It's very close to all-time highs. However, this still suggests that risk on is the nature of the beast, making a new high in this particular ratio. Let's move along and take a look at the dollar, and the dollar is moving higher. So this is where we start to get into the first divergence of this market, but you have to think about the market as having a brain, if you will, and it's really just the collective conscious of the participants in the marketplace. And as you know, based on the headlines, if you even take one look at CNBC, it's all about the Magnificent Seven. Nobody cares about the dollar right now. And it's not that the relationship between the dollar and equities is not important. It will be at some point, but the zeitgeist, so to speak, of the market is all about the Magnificent Seven and the rotation that's taking place there. I could even start to imagine how you start getting some headlines about small caps coming up from the rear and bolstering the breakout in the S&P if it can truly break out of that weekly range. I don't think we're there yet, but when and if that starts to take place, you better believe some headlines will be written about small caps. And again, that sort of diminishes at least the market's collective conscious concern about the dollar. We're definitely higher here, so in theory that would be a headwind for the market down below, but we really just went sideways. Nothing to write home about, and I certainly wouldn't short the market just because the dollar is higher here, in theory adding to tighter financial conditions. If we take a look at the gold contract, just to get a sense for maybe what the dollar might do next, this is offering nothing, like quite literally nothing. It's in the midpoint of a balance range up here, not much to go on. So you're not going to look at gold for an indication on the dollar. We can look at silver, which has tended to act as a leader to the gold contract, and this too is pretty much unchanged at the equal lows here at 22.50. Tried to break down on the Wednesday session, closing underneath, right back higher on Thursday and Friday. So if this continues higher, the dollar, in theory, should move lower and therefore alleviate some pressure on equities. So we'll see if silver gets more interesting. To me, it would have to be up and over this level here. What would that number be? Around 23, let's call it 23.40, just for round number's sake on silver. A break there, in my eyes, might put some downward pressure on the dollar, alleviating pressure here for equities to continue in the upward direction. So not really seeing that as a bearish relationship. Let's take a look at the TNX and see what's going on with interest rates. This will be very interesting this week because of the CPI release. However, this is a flat top breakout point after this, so I'm possibly looking at it through the lens of double bottom. If we break out through that, I'd be very interested to see what the reaction is at 43.33. Remember that Powell has basically said rates are not going any higher on the Fed funds rate. So the market would have to do the job of raising rates above this level because, as we know, if we bring out a weekly time frame chart, there's your previous pivot top. This is where we had some concerns about, higher for longer, really sticking higher for longer. We're currently getting higher for longer. It's all about the May timeframe meeting now, and we're still underneath that level. If it's the nail in the coffin for rates on a higher time frame, you want to see that act as a lower high, equal low, and then we break down, especially if Jerome Powell can help us out here with some cuts maybe in the midpoint of the year. So with that said, let's take a look at the inverted ZT, get a quick glimpse at what the Fed tracker tool should be suggesting. The more time we spend over this level right here at the 102, 165 number, we are looking for decreased odds of a May cut and really waiting for the June timeframe to see the market saying, okay, now we're expecting the cut to come into place. So this little lift into the end of the week, to me, would indicate that the probability is probably increased as we get, as the week we're on, the probability is increased for a pause in the May timeframe. So let's take a look at the tracker tool now. So that's exactly right. When we checked in on Wednesday, we had 36.6% odds for a pause in May, and now it's 39.3% odds. And keep in mind, if this does ultimately flip over to a pause, we've now gone from pricing in 6 cuts in 2024 to 4 cuts in 2024. And the only thing that's sort of continuing to justify the valuation might be that earnings finally started to tick in the upward direction instead of continuing to drift in these downtrends that they were in for quite some time here. If we look at the calendar for the coming week's worth of trade, we do have the CPI prints coming out on Tuesday at 8:30. We'll be live up in the penthouse with coffee and donuts for you all. We are expecting a 0.3 on the month-over-month core. The annualized core is expected to come in at a 3.7. Prior was 3.9. It's certainly not 2%, but we're making moves in the right direction. This 0.3 annualized is 3.6, so we're still not all the way there. We want to see this continue to trend in the downward direction, which it certainly is doing. One thing I would just make note of is if inflation does continue to fall, if we get a lighter than the expected inflation print here, let's say that we get a 0.2 or a 0.1, that of course to me would indicate that the odds of a cut here remain quite firm in terms of the market's pricing in. Hey, the battle against inflation has been won. Jerome Powell was like, we want to see continued data. We want to see continued data. If we get something that looks good here, I would think that maybe they would be more apt to cut sooner rather than later. Why risk breaking the labor market, perhaps, right? We will continue to keep an eye on unemployment claims. Last week was a solid read. Remember that we were on this trend and trajectory here of missing the expectations. Here's expectation, miss, expectation, miss. Here was the expectation. We certainly beat that expectation. We're still elevated, don't get me wrong, but the fact that the market's sort of not going to be shocked by those higher numbers does strike me as a good thing for keeping the labor market intact and just keeping in mind the odds of the soft landing continuing to increase here. As long as the labor market doesn't break, break, I think Jerome Powell may have pulled off a miracle, even though people seemingly don't want to give him credit for it. I don't know why. The guy's got a really tough job. Let's take a look at the revisions to CPI, and this came out on the Friday session. The only revision, which was a revision in the right direction, was the August timeframe, right? We went from a 0.3 on the X food and energy, which is basically core, right, to a 0.2. Everything else was the exact same. No changes there. So that is a step in the right direction. Maybe inflation is better than we thought. And what we do need to look at, because thank goodness for the chat on the Friday session, you guys were telling me all about the Canadian labor report came in far better than the expectation. And this is, in my eyes, why the market saw that big blip in the upward direction. So when we look at these two things, it was the revisions to CPI and the Canadian labor report, right? And here you can see that there was this big plunge. And that, of course, means that the dollar was getting weaker against the Canadian dollar. And therefore, that's sort of the market sort of was like, okay, this is going to act as a small tailwind in the pre-market. Now, it didn't stick. And again, remember our conversation from just a moment ago about the zeitgeist being all about the core list of companies, the Magnificent Seven, the rotation into small caps, but it helps explain maybe what happened on that Friday morning session. So we'll continue to watch that. But good news out of Canada, INF, if you're watching, hopefully everything is all good up there. We talked about earnings moving in the upward direction. Earnings for this week, if we take a look at earnings whispers, let's take a look. It's all about lower tier tech and some consumer staples. I'll be watching Coca-Cola. We saw what happened with PepsiCo on Friday. Really didn't go so well. Lower tier earnings in terms of the tech sector. We're talking about Shopify, Datadog here, Airbnb, Robinhood, if you want to get out your popcorn. What else is important? Cisco, perhaps, as a lower tier tech. Kraft Heinz from a consumer staples perspective. What else here? John Deere Industrials, Roku, lower tier tech, the Trade Desk, advertising, right? Applied Materials in the chip space. Those are some honorable mentions. That's what really catches my eye here, but nothing that's as market moving compared to the week following, which is when we finally get earnings from NVIDIA. What about the market's appetite for risk? The TLT ratio to the S&P is certainly not suggesting a flight to safety trade unfolding. If we take a look at bonds in relationship to themselves, these are moving in the upward direction, which at first glance may seem like an issue, but if we check in on credit spreads, they are continuing to remain stable, even with the New York Community Bank sort of blow up, if you will. Remember that this is Silicon Valley Bank blowing up in red here, just not even close. So the risk of a credit event seemingly is much lower than what we had almost a year ago now in the early stages of March. So again, seeing those bonds in relationship to themselves moving in the upward direction is not really concerning when credit spreads not offering any huge risks in the credit market, basically. Let's take a look at the HYG in isolation, and you can see that we are divergent here with a lower high versus the higher high that we have in equities down below. It's not enough data by itself to say, hey, we should be looking for shorts, but maybe just don't chase breakouts when you have no way to manage your risk in the upward direction on the S&P equities. So that's how I'm continuing to read into this data point over here. Let's take a look at Bitcoin. Bitcoin broke out big time on the Friday session, moving in the upward direction. Speaks to risk appetite remaining solid. Again, all of these risk appetite charts speak to this is a bullish market. I would not be trying to short the all-time highs just because you want to be a contrarian or you feel as though the bubble is about to burst. Let's take a look at market breadth, new highs versus lows, certainly ticking in the upward direction. Let's get a closer zoom there. Subtle shift in the upward direction. That, of course, is bullish. Let's take a look at the SPX A200R. Really unchanged on the span of multiple weeks now, just going sideways, but still above 50%. So that's healthy, but certainly not improving. SPX A50R, small improvement into the end of week as the S&P was breaking in the upward direction, but still off of these major highs, much more concerning when and if we fall underneath 50%. The biggest takeaway in terms of breadth is going to be your equal weight RSP. I could understand wanting to call this a bubble, wanting to short the top, if this was moving aggressively lower, or maybe it was stuck in the midpoint of this range as the S&P was breaking to new all-time highs. But look at this chart. I mean, you're getting a pie in the sky inverted head and shoulders, potentially breaking out into the end of last week. This is not a market where I would say, yeah, go for it, short the all-time high. And I know I left it open-ended on the weekly time frame chart because not as many folks will make it all the way to this point. You can clearly see where I stand, right? This is not a bubble yet where we would say, oh my goodness, we're so divergent, it's only 3 stocks that are leading the S&P higher. If that were the case, then the RSP would still be down here at 147. It's just not as of right now. Let's take a look at the QQQE and see what's going on in the NASDAQ. Equal weight, same concept, breaking. It's in sync here. It's not massively divergent. And even if we look at the Dow transports, they're still, like, don't get me wrong, they're certainly lower from here to here, whereas industrials have made a new all-time high. But this, on a relative basis, trying to to break out of this range. If it can go up and over 16,150, that would be supportive of, hey, it's trying to play catch up. The broadening nature of the market rally is truly becoming a reality. Let's check in on market volatility. VIX is really not offering anything here, still floored underneath 15. What about the VVIX volatility of volatility? Taking a closer look, we're just contained at a very comfortable spot for the VVIX. We will be more concerned for the complacency effect if this continues down towards 75. What about VIX futures? They are moving into a stronger contango here, not a backwardation, so no issues from a volatility point of view. Even the one-day VIX, really remains underneath this. This is kind of where we had that larger debacle in the Q4 of 2023. Just no issues out of volatility. Everything's all good. Let's take a look through the skew and see if people are betting against us. Yeah, absolutely. You love to see it, right? So what this tells me is that people are betting on a black swan. People are saying there's no way this bubble is going to pop and it's got to move lower. And that doesn't always have to be the case. We know that the skew is always more powerful, which is why we've set it up this way, to show us where bottoms are when everybody's thrown in the towel. Because at that point, the natural buying activity of the market takes over and you likely see some sort of bottom start to form. So as of right now, a lot of contrarians out there, but they just continue to get run over on the weekly time frame. Let's take a look at the core list of companies. If you've made it to this point in the show, I appreciate you coming out to the analysis. Do me a favor, hit the thumbs up button, subscribe, all that good stuff, and we'll kick off the core list of companies with Apple. You can clearly see how it lagged this week, totally just going sideways, slightly higher on the week, but nothing to really write home about here. It's building out a bit of a balance range, and I would be patient in Apple and say, okay, stronger longs are on higher lows over 190.85, and anything to the downside is tradable here on a lower high underneath 187, because you're really starting to look at high, lower high, potential lower high, and rejection of the daily 50 SMA. Notice on Friday, we tried to get up and over these equal highs Monday and Tuesday. On the Wednesday session, we tried to use it as support, rejected it on Thursday, and in that upper wick on Friday, just couldn't make it happen up and over the 189.25. So any continued consolidation down here, I'd be more apt to trade this in the downward direction underneath 187.15. Downside target would be 184, and then you can walk it down to the equal lows at 180.25. If they're going to rotate into Apple, again, just wait for the confirmation via some sort of higher low over 190.85. Next up, we're going to take a look at Microsoft, top dog in the S&P these days. Just total balance range breaking in the upward direction. Let's take it on down to the hourly time frame chart because this really illustrates why the levels are so important. I mean, prior resistance in the upper wick from earnings, resistance here, resistance there, total consolidation above. And what was the result on Friday? Bought it, broke it out, total move to the upside. Nothing bearish to say about this chart. If the sellers were really going to have an edge, they should have either materialized with a lower high over here, or on this breakdown, they should have offered a double top with a breakdown through the equal lows, lower high, same idea, underneath 402.75. So as of right now, top dog in the S&P ripping to the upside, new all-time highs under the circumstances like this. Very hard to be a contrarian and say, oh my goodness, the market's going to go to zero, right? There's a strong opportunity for just yet again a daily higher low now up and over. I would argue that this is the number you want to see respected at 412.50. If you're trying to trade this for a pullback, yeah, you could look for something underneath the afternoon consolidation from Friday at maybe 419.25, looking for a thin structure retracement. But please do not overstay your welcome on the short side here in Microsoft. Next up is Google, another ripper to the upside on a beautiful hold up and over the equal highs. We talked about this on Wednesday. Thursday, fantastic. Over that 145.40, continuation in the upward direction, blasted right through the double gap here from 147 up to 148.20, consolidation at the highs, a pullback for a higher low inside of the gap range, good to go. I would watch 147 as a potential area, or even just your Thursday highs. You can see we got a beautiful gap for reversal on that Friday morning session. Let's go 46.15. There we go there, round numbers only up in the penthouse. So, really hard pressed to say anything bearish, even if we're getting a pullback that looks like that. This, in my eyes, yields the deeper pullback in the S&P to maybe close the gap underneath, but nothing more if we can still find buyers around these zones. Same thing would hold true for Microsoft, right? As that pullback is taking place from the all-time high, you don't want to be overly bearish, but just understand that the S&P is likely going to feel some impact from that. Moving along to Amazon, again, everything kind of just broke big time on Friday to the upside. If you watched the Wednesday update video, we talked about the rotations, right? Here you go. Higher lows over 172.35 continue to trade in the upward direction. Do you want to be chasing it up here? Probably not. If it does drift higher, I would want to see price acceptance over 176 and then continuation. Otherwise, really waiting patiently for a stronger pullback to offer some sort of higher low now that we've broken out of this as a balance range. The doubling of that range is loosely around 176. So you could look for that continuation. But again, how do you participate? Where's the risk-friendly entry? Leaves a little bit to be desired. The time to be long was really on the Friday session. Moving along to NVIDIA, rinse and repeat. I mean, what else do you want from this market? Rinse and repeat. Prior highs, prior highs, prior highs, turning into support here. Same concept on the Friday morning session. Prior resistance acts as newfound support. Blue sky territories, new all-time high, the one stock to rule them all. Don't bet against it, right? So keep it simple. Any higher lows now that look something like this really offer a mirror setup to what we have over here. So 704.50, good to go. Anything above that, I mean, it's just blue sky territory, so one step at a time. Next up is the metaverse. This one leaves a little bit to be desired and obviously underperformed on the Friday session there. Totally sideways in the range. It's not breaking down aggressively, but it does offer, now that it's just sideways in this range here, two easy setups, right? Either you're looking for the break and higher low above 473.50, very similar to Apple almost, but the range is a little bit more compressed, right? So if they're going to rotate into Meta, you'll know on the higher low over 473.50. If they break it down underneath 466, great. Lower highs underneath will trade in unison with them through the thin structure all the way down towards 453. And when I say them, by the way, and we're talking about markets, we're talking about that collective conscious we were describing earlier on the dollar chart, right? Next up is Tesla. What do we see out of Tesla? This is still an hourly time frame chart, folks, trying to grind in the upward direction. And again, that rotation on Tuesday really helped prevent the market from seeing some larger downside. And we saw the follow through. I mean, decent weekly show here out of Tesla. The next big watch is waiting for price acceptance over 192.92, 193 if you want to wait patiently for that, the whole dollar, right? Prior resistance rejected here. Couldn't really make it stick on that first go around and rejected in that upper wick. So I would want to see some price acceptance above before getting overly aggressive on the longs for the gap close up above to 206. We have gone wall to wall, but the move has been very, very respectful. A lot of two-sided trade in here. It's not total domination. The chart doesn't look something like this, and then consolidation. Now we're looking for a breakout, right? You can see there's give and take, there's give and take, there's give and take, so on and so forth. So any consolidation here continues to set this up, but watching for the higher low above to get a little bit more confident that the rotation can take place through the gap range into that 206. This gives me a little bit of a worry, just understanding these two previous interactions at the 193, we'll call it just for round number's sake. Next up is Netflix, last but certainly not least. And again, another easy one, so to speak, in terms of identifying the setup, just like Meta, just like Apple. Wait patiently over 569, under 558.25. The home stretch, I've got 5 additional ideas for you. First up is JP Morgan, ticker JPM, and thanks to Mr. Demon for setting this one up. We've got a flat top breakout into blue sky territories on the heels of a major run in the upward direction. So momentum is here, and think about the thesis, think about the concepts of today's episode, right? We're talking about market rotation. If tech is going to take a breather via some sort of pullback, and if financials can break out at the sector level, this individual idea may be a way to participate in the continued upside for the broad market, right? So over 176.25, looking to trade into those blue sky territories. If we just consolidate and maybe even drift lower, I'll keep it on my radar, but not really interested in taking breakouts or taking longs here until we've actually cleared that level, again, 176.25. Next up, we have UPS. What's going on with the shippers here? Again, think about the concepts in today's video. If tech is going to take a back seat, this as a cup and handle is fairly interesting, and for that reason, I'm more interested in the gap close overhead. Can we get up and over 149.50 to close up towards 156.35? If we take a look in the hourly time frame chart, we can't lie to ourselves. If this is going to be a double top in the immediate term and we break underneath this neckline more meaningfully, we do have thin structure to retrace underneath, so the opportunity for a downside trade here in UPS is available. But again, thinking about the concept of the video, market rotations, keeping a sustainable uptrend in the S&Ps, can we get the gap close overhead in UPS? Watching again, 149.50 as your key level. Next up is going to be SQ. What's going on with Square? Here it is. We're still on an hourly time frame chart. Keep in mind that this is sort of a rounded bottom. On the daily chart, maybe it's an inverted head and shoulders, but we need to be patient out of this one for the clearance of 71.50, and then we have thin structure to retrace up towards this gap. Here it is on the daily time frame chart. You can start to see again that rounded bottom, maybe inverted head and shoulders if you draw it in like this. Be patient. You need the break. because on Friday we actually have more of a bearish engulfer, kind of rejecting the 50 SMA. So it's in play as long as this sort of trend line can maintain itself in the very immediate time frame. We're talking about this right here. If we just continue to grind, it'll stay on the radar. But again, you need to wait for the break here. You've got to exercise some patience in SQ. If it's too close up against earnings, probably just falls off the radar in its entirety. But I thought the pattern was very, very clean here on the daily time frame with this breakout level against 71.50. Next up, we've got some lower tier tech to start talking about. DocuSign, DOCU is the ticker on this one. And if the tech sector is going to take a breather, again, these trade ideas are very intentional. We're thinking about the thesis here. If the lower tier tech, if tech is going to take a breather as a whole, the lower tier tech companies are the ones that have the most relative weakness. There's a massive double top here on DocuSign. I don't think I've ever seen something more obvious as an M period or an M pattern. Maybe they're thinking, hey, Trade Brigade Matt, TB Matt, we're going to give you a big M. So thank you, DocuSign, but I'd love to see the lower high reattempt underneath the neckline. I'd love to see this break down as a bear flag, trading this in the downward direction. So DocuSign, lower tier tech, looking for shorts if the market takes a breather in something like the QQQ. Last but not least, it's a similar concept in AFRM, a firm, and what we have up here is more of a bearish engulfer. So obviously earnings are in the rearview mirror, but look at how we moved up and over the high of that bar to close underneath. Very, very bearish, right? Technically, this is a solid run in the upward direction ahead of earnings. This rejection up here has me slightly concerned for the longs, and I would think that if we can really break down underneath Friday's low, you're looking for an equal low reattempt. If that's not your mojo, that's fine. Wait for this to confirm as some sort of like lower high or equal high. What do we know? This will maybe act as a weekly double top. There's your M pattern again. And what do we have? Thin structure to retrace. We're talking about a move from 38, let's call it 38.20. Round numbers up here in the penthouse. I have no idea how that one slipped past me. There we go. Thanks for keeping me on my toes. But there we go. We're looking for 25.75 on the downside, perhaps as a potential target if the tech sector slips. The weaker tech names are going to be the ones that go. This rally can be retraced. In my eyes, a firm buy now, pay later. It's not really going to hold a candlestick, no pun intended, to something like your Microsoft ripping near those all-time highs. That's all I've got for you in today's episode of the Weekly Watchlist. Thank you for coming out to the show on a Super Bowl Sunday weekend. Let me know who you've got in the comments section down below. I don't know much about sports, but I do know there's a big sort of tension point between the underdog and the 49ers and maybe the overhyped, overblown Swifties team, and we'll just leave it off at that. Anyways, I hope you have a fantastic trading week up ahead, and we will see you in the next one.